Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about the proposed 2021 GASB Implementation Guide. So on an annual basis, GASB goes through and updates the implementation guide based on questions that come into the GASB. And so very often, if you are one of those people who calls the GASB, it would not be unsurprising to see in an implementation guide that questions show up. And I've actually had that happen before. And so when we're going through implementation, we're able to get these Q&As issued by the staff. And again, these are, they're going to be authoritative because they go through this exposure draft process. And so in November, they issued the proposed implementation guide for 2021. Comments are due February 15th of 2021. And again, it's just Q&A on a variety of standards as part of this. So some of the topics that are covered for the new questions, they cover some questions about derivatives, fiduciary activities, the gift that keeps on giving, leases, no surprise there, as well as non-exchange transactions. I picked out a couple of ones that I thought you might be interested in as we go through this. The first one, for purposes of evaluating whether an employee benefit plan, could be a pension plan or an OPEB plan, or some other employee benefit plan like a 457 plan, is a fiduciary activity in accordance with the requirements of Statement 84, is the Internal Revenue Code section 403B or 457 a determining factor? And clearly the answer here is no, right? You have to look instead at the characteristics laid out and identified in 84 to determine whether something is a fiduciary activity for financial reporting purposes. We do not use the tax code as the driver here. Another GASB 84 question, a local government remits resources to a third party that is administering the local government's defined contribution pension plan. So they remit the funds to the third party. The defined contribution pension plan, though, is not administered through a trust that meets the requirements in 67. The assets are held, though, by the third party until they are distributed to employees. How do you report the amounts that it remits to the third party? Remember, when you are not in a trust, any assets are reported as assets of the government. So in this scenario, the amounts that are remitted to that third party are not outflows of resources. Those items continue to be reported as assets of the local government because they're not in a trust. And so I think that's a great clarifying question. For leases, again, have to throw in a lease question here and there. A city owns a fleet of equipment. The pieces of equipment are capital assets of an internal service fund. And so this is something that, different departments can go out and rent or use the cars for government business. The Internal Service Fund is used to report fleet management activities, which provides other departments of the city with the right to use the equipment on a cost reimbursement basis. The question was, is this now a lease? And the answer is thankfully no, right? So it does not convey the control of an underlying asset to another legal entity, right? So this is just a different department. And so in this scenario, it's not conveying the control to use another entity's underlying asset. And so interfund agreements are excluded from GASB 87. So grateful for that clarifying question. Another one that I really liked in terms of questions, a government enters into a 72-month lease as a lessee. However, both the government and the lessor have a right to cancel at any time without permission from the other party with a 24-month advance notice, right? So we have a non-cancelable period, but we have a cancelable period. Therefore, the initial term is 24 months because that's the period of time that, initially we're locked in for 2 years, because the remaining 48 months are cancelable at the commencement. At the end of the reporting period, neither the government nor the lessor has exercised their right to cancel. The question was, now do I have to reassess the lease term? The answer is now yes, because if you haven't exercised it, you really still have 24 months to go. And so Statement 87 says periods for which both the lessee and lessor have the option to terminate without permission are cancelable. And so in this scenario, the new period of time is going to be 24 months. Therefore, we need to reassess the lease term at the end of the first reporting period and subsequent reporting periods as applicable. And then I guess there's two more lease questions. Again, I love this. A lease, government leases office space and is one of several tenants in a building. In addition to fixed payments, the government is required to make payments to reimburse the lessor for its pro rata share of the lessor's taxes and insurance. The additional monthly payments are stated in the lease based on the estimate of taxes and insurance at the beginning of the year. Annually, the lessor provides a reimbursement or requests an additional payment from the government to account for the difference between the actual and the estimated pro rata share. The question is, should those additional monthly payments be included in the measurement of the lease liability? And thankfully, the answer is no. Taxes and insurance are non-lease components, so they would not be included in the present value calculation. All right, and one more lease question, just because I think the lease standard's been so interesting for implementation. A government leases retail space to a vendor for 10 years. There is a minimum guarantee payment for the first year of $100,000. Very common to have minimum annual guarantees, especially in airports. And so most airports that are governmental have these minimum annual guarantees. And so those are going to be met by the retailers as well as the restaurants. The minimum guarantee payment for the second year is a fixed percentage of sales in the first year. So we know that the $100,000, if they have more than $100,000, as they go through that fixed percentage, it would adjust. Likewise, the minimum payment for the third year is a fixed percentage of sales in the second year. The question is the government required to remeasure the lease receivable each year because the sales of the preceding year become known? And thankfully, again, the answer is no, because it's a contingency upon which future, right? So it says variable payments that will be received over the remainder of the release term are based as resolved. And so these are only telling us about past items. We still don't know about those future items, so we would not, thankfully, have to reassess in that scenario. In addition to new questions, they also include updated questions. Some of them are terminology oriented or language oriented, and some of them are actual changes to the interpretation. So the areas that they covered were basic financial statements and MD&A, intra-entity transfers, and intangible assets. So I did want to point out that in the guide, there is an appendix. So after you go through the set of questions, the appendix actually shows the markup. And so you can see here, this is really clarifying. It's not, I don't think, materially changing it. It does provide a little bit of guidance here. And so it says authoritative pronouncements do not address the manner in which capitalization policy should be established and applied. They took that out. Instead, they answered capitalization policies adopted by governments include many considerations. And then they took it out like it may be appropriate for. It now says a government should establish. So I think it's more of a language clarification here. However, I like the last sentence, which really is the outcome to the question and really answers the question a little bit more clearly. So a little bit of clarification in this scenario. And so never stop at just the, the actual Q&A. The changes are really helpful when you look at them when they're in the marked up option. All right, that's a wrap on this week's blog. I hope to see you on a future blog. Have a great day, guys. Bye-bye.